Well, good afternoon, everyone. My name is Kevin Minton, and I'm the owner and CEO of Chief Executive Boards International. I'd like to thank you for taking time to join us for today's webinar on estate planning. Chief Executive Boards is headquartered in Greenville, South Carolina, with executive peer advisory boards in multiple cities throughout the United States, and I'll be your host today. I'd like to invite you to stay tuned for future webinars on our website, which is located at the bottom of this slide. So before we dive straight into our main topic, you might be curious to learn a little bit about Chief Executive Boards. Essentially, we're a boutique executive peer advisory service with local and national boards located throughout the eastern and midwestern states. And the purpose of CEBI is to help CEOs, presidents, business owners to share ideas and experiences, really to avoid the pitfalls and potholes that many have already experienced. Essentially, we help steer you from reinventing the wheel within your own business. It's where highly successful chief executives go to become even more successful. Our members convene in face-to-face forums, and they receive unvarnished advice in a safe and confidential environment that's typically unavailable elsewhere. It's kind of like having your own personal think tank. So as an example, we address what keeps you up at night, items that you don't have an opportunity to discuss with anyone else. Our members can avail of local and national advisory board forums and attend educational summits, and they have access to other CEBI members and libraries, our workshops, and our webinars. So before we get started here, just a couple of housekeeping items. The webinars will last about 45 minutes today, and you'll be able to post your questions in the panel on the right-hand side of your screen, and we'll answer those at the end of the webinar. The webinar is being recorded, and we will make it available for you to review on our website. At the end, we'll have our contact details listed at the end of the presentation. So let's get started with our webinar on estate planning. Our guest presenter today is Mr. Roger Brooks. He is a managing director with NFP Insurance Solutions out of Chicago, Illinois. He is a recognized leader throughout the U.S. in estate and philanthropic planning, wealth transfer, and executive benefits. And at this time, we'll go ahead and turn the presentation over to Roger. Roger, are you there?
I am, Kevin. Thank you so much. And I really appreciate Kevin asking me to do this, and I feel honored to share with all of you a little bit of what I hope will be helpful to you. And to start out, what I'd like to ask, because I'd like to somewhat tailor the presentation, Robin is going to do a poll here that will ask you, as far as estate planning, executive benefits, etc., are you more of a beginner, an intermediate, or are you pretty experienced and have done a fair amount of planning? And that way, when I know our audience makeup, I can maybe tailor the presentation a little bit so that if most people are fairly experienced, I can go through the elementary stuff a little quicker, and if not, I'll spend more time there. So, all right. Let me go ahead and start then. I'm having a hard time, Kevin.
Yeah, that's because the poll's open. So.
Oh, okay. The poll was going on. All right.
Yeah.
All right.
So Robin,
All right, good.
Robin's going to be sending you the responses to the poll here, Roger.
Excellent, excellent. So let me start out, and it looks like we've got kind of a combination of beginner and intermediate. So that's good. That kind of helps me where we want to go with this thing. I've been working with primarily business owners for 37 years, work all over the country, have some special alliances with the 10th largest CPA firm in the country to do the work for all of their clients. I'm not affiliated with any particular insurance company, so a lot of what I do is really more advisory work and trying to help. Some of it has nothing to do with insurance and is just kind of estate planning ideas, and typically working with a team, which many times will include either a CPA, a tax attorney, a trust officer, a family office person. It just might vary on who it is. Kevin, I'm sorry, but I'm having a
You need to advance the screen. You need to advance the screen, Roger.
Yeah. Can you do it?
Yeah.
Okay. Why don't you just do it, and I'll go from here.
All right.
I think that'll be better. So the first thing that I deal with often, and I wouldn't be surprised that many people on this call fall into this, is that you spend so much time working in your business and trying to do that and spend some family time when you can, that procrastination is one of the biggest things I come across when it comes to planning. And it's kind of the old, well, I'll cross that bridge when I come to it. Well, the bridge is here. So if you could go to the next slide, the earlier that you can do it, the better you're going to be. So what I'm going to talk about today is, first, what is the current gift and estate tax structure? Core documents that really everyone needs, whether you are worth a ton of money or a smaller amount. Some ideas on how you can reduce your estate but keep control of your business, because as business owners, the number one thing I hear all the time is, well, yes, I wouldn't mind trying to, reduce my estate taxes, but I don't want to give up control of my business. Irrevocable trusts, and can you change them? The word irrevocable typically means you can't, but that's not necessarily the case. If life insurance is a solution, a tool as part of the planning process, would you rather pay the premiums or just the interest on the premiums? Kind of a unique way to look at this. And the last one is, how can you create a family bank using tax-deductible company dollars? And so some of these are going to be applicable for you, some won't be. You can go to the next slide. What I'm hoping is that at the end of this, you're going to be able to come out of here with at least one or two ideas that you may wish to explore and or help you with what you're doing. So let's just talk about what are the taxes currently for estate and gift tax for 2016. Well, first off, a spouse can give an unlimited amount of assets, doesn't matter what kind of assets, to their spouse, no gift or estate tax due at that time. In addition, if you want to give money to other people currently, each person has a $14,000 annual exclusion per beneficiary for gift tax, or $28,000 per couple. So as an example, if you just wanted to give your children money, you could do up to $28,000 per person for a couple, and there's no gift tax due on that. If you had a trust, and in the trust you had 4 children and 8 grandchildren that were primary and contingent beneficiaries, you could actually fund that trust with 12 times $28,000. So it all depends on, number one, what stage of life you're at. Are you still in an accumulation phase, or are you at a point where you are trying to reduce the size of your estate as much as possible to reduce estate taxes? So then each person has at this year, a $5.45 million lifetime exemption per person for estate tax. So that means, other than a spouse, because I can give an unlimited amount to them, I can give to anyone else that I want to up to $5.45 million or $10.9 million per couple, and not be subject to any estate tax. So hence, if your total net worth in your estate is under $11 million, round figures, you're probably not going to owe any estate tax. One thing that came out in the last year was a new rule that said that we used to have to do this through trusts, that if one spouse doesn't use any or all of their lifetime exemption, that it will automatically be added to the exemption of the first spouse. And I specify first spouse because if I died and I didn't use any of it, my wife now would have $10.9 million of a lifetime exclusion. But if I then remarried, my new wife doesn't get that. That retains with my first spouse. So there's some kind of interesting aspects of that. Any assets that you have, I'm going to call them stuff because it could be anything, over that lifetime exemption are taxed at 40% for federal estate taxes. And then some states also have an inheritance tax. Not all do, but I showed one because I know we have some people that are in Illinois. Illinois, you pay an additional 16% on anything over $4 million. So there's a chart that I have later on, I think, that shows some of the states and what they do. If you have a question and you want to ask as we go through, that's fine. I think Kevin would like maybe to wait to the end, but take notes or whatever, and I'm happy. We're going to have some time for questions.
Yeah, just post that at the end and we'll be fine. Okay.
So just a little thing to lighten it up, little cartoon. After federal, state, and local taxes, you get 1/3 of a wish. We all don't like to pay taxes, although I have to say paying taxes is better than not paying taxes, because at least that means you're making money. Next slide. Okay, so estate planning really is very simple. It's the strategies involved that can get complex. So the green bucket with dollars in it, and that bucket represents all the stuff you own, your business, your homes, stocks and bonds, your 401k, your boat, anything that you have. That's all in that one bucket. And you have 3 choices as to where all that money is going to go. One is and it can go to a combination. It doesn't all have to go to one. One, it can go to family or whoever you want it to go to. It can go to charity, or it can go to the IRS. Don't know how the rest of you feel about it, but my personal feeling is I'd rather see somebody else managing whatever money I'm going to end up giving other than the IRS. So if we go to the next slide, here are some core documents that really everyone should have. Again, doesn't even matter on the size of your estate. The first is you should have a will, because a will avoid going through probate. You can determine within limitations who's going to get what. A lot of times, if you do have younger children, a guardian may be put in there, but everyone should really have a will. You should have a financial durable power of attorney. So that is giving, if you are incapacitated and cannot make decisions, you're giving someone else, can be a spouse, can be a relative, can be an attorney, can be anybody, but you're going to give somebody else the authority to make financial decisions on your behalf. A living will with a medical directive. So that's the one where it basically is talking about, do I want a do not resuscitate if I'm in a situation where I'm on life support and the odds are that I'm never coming out of it? Or specifically, you know, what am I willing to do before that? So that's what the living will and the medical directive are all about. The health care power of attorney somewhat goes along with that, and again, you're giving someone the authority to make decisions if you are unable to, you're incapacitated, you have Alzheimer's, whatever it may be, to make decisions on what kind of health care that you can provide. When you go to the hospital, they're always asking for, you know, somebody to authorize whatever's going to be done. And the final piece is a revocable trust with generation skipping planning. A revocable trust is more specific than a will because you can get into some really specifics of how you want these assets distributed. Not only to who, but when, what conditions. You can make it as strict as possible, as loose as possible. You can put things in the trust that would say, you know, they can use money out of here to put a down payment on a house, or to start a business. Or you can even put things in that says, I'll match dollar for dollar whatever you earn for a child that maybe is not overly enthusiastic about working. So anything that you want, you can change that at any time up to your death. At your death, then it's done. The generation skipping planning is just allowing for, especially if you're in a situation where your net worth is over that 10 or 11 million, generation skipping basically means that you can structure a trust so that although the second generation can have access to the assets in that trust, if there's anything left over when the last of that second generation dies, there's no estate tax due at that point. Whatever's left goes directly to the next generation. And that's something that we use a lot in planning. Okay, next one. Kevin, you there?
Yeah, I'm with you.
Can you go to the next slide?
I'm attempting to do that. Bear with
okay.
Me. Yeah, bear with me just a second. Roger, have you moved the mouse?
I moved my mouse.
Yeah.
Did that do something?
Yeah, I think it gave you power to.
Well, no, mine isn't doing anything.
All right, bear with me just a second. It's going to take me just a second.
While we're doing this, since we do have a gap here for a second, are there any questions relating to anything that we've discussed so far?
If you do have questions, you can post them over in your question box panel on the right-hand side.
Roger, can you hear me?
I can.
I do have one question for you. We have a question that says, is the state inheritance tax per person over $4 million, or if your estate is over $4 million, are you paying inheritance tax on the excess?
Yes, you are paying that inheritance tax to the state on any assets over $4 million.
Robin, I seem to be locked up here on this presentation. Can we switch over to your presentation?
If I can give it back to, yeah, because you're still showing as the presenter.
Just bear with us, folks. We'll get it back to the right presentation here, where it's advancing. For some reason, GoToWebinar the past 2 days has had some problems, but anyway, we have a backup plan here.
Going back to that last question, most of the states, if they have an inheritance tax, it is kind of blended in with the federal tax and says if you pay the federal tax, then you don't owe the state tax. So there aren't too many states that have a separate one, but you know, depending on where you are, not a bad place or not bad to make sure whether you're in one of those states or not. I looked at the chart that I have, and knowing where most of the members are, Illinois was one of the few that seemed to have one. So if there's anyone on from Illinois, I apologize. But I have no control over that.
All right, Roger, I think we're about there.
Yeah. Okay.
Is this where you left off?
Yeah, this is good. Okay, so going to, we talked about core documents and the revocable trusts and all. If you just go down all the way to the bottom, you've got a couple there. They can fund a revocable trust with interests in businesses, real estate, other assets, cash, anything can go into a revocable trust. Does not have to be liquid like stocks and bonds or anything like that. You can create a lifetime trust where the trustee for the beneficiaries is in charge of how they get money, literally for their life, as opposed to the way sometimes trusts used to be set up where the children would get, you know, a third at age 25, a third at age 30, and a third at age 35. I personally am not in favor of that because I think, you know, everybody's different and you can make it as liberal as possible and still have a little bit of control. It does avoid probate, so you don't have the costs with that. You retain a lifetime control. And it is creditor and divorce protected for descendants, and that's pretty important these days with as many divorces as we get. So this is also an asset protection strategy. Okay, next one. Okay, so some of the things that we want to talk about today are how can you keep control of your business? Keep going. Asset protection, strategies for asset protection from, as we say, both creditors and predators, predators being typically ex-spouses. How you can reduce your taxable estate. How can you pass increase in asset value with no tax? How can you leverage IRAs? And so the first one I'm going to talk about is one way of discounting an estate, and that's if you have a company that has just one type of stock. you can recapitalize that into voting and non-voting shares. They did 10% voting, 90% non-voting. I've seen it 1% voting and 99% non-voting. The non-voting shares are where the money is. So the voting shares really are worth very little, and the vast majority of the business worth is in that non-voting shares. So we talked about earlier about not wanting to give up control. Well, here's a way that you can recapitalize the business, move 90+% of the value of that business into either an irrevocable trust or a family limited partnership or an LLC to a family limited partnership. There's a number of ways you can do it, but this is one way of avoiding some estate tax. You still retain lifetime control because you're the only one with the voting stock. You can sell non-voting stock and limited partnership interests to an intentionally defective trust. Don't worry about that. And many times by using family limited partnerships, you also can get a discount since there is no voting shares. Typically 30 to 40% the IRS will allow as a discount for either a minority share or a non-voting share. And again, by doing these things, you get a creditor protection and liability protection. So on to the next one. Okay, and I'm going through these obviously pretty quickly just because I want to give you some different ideas, because one may be applicable to you and you'll want to expand on it more and learn more about it, and one you may have no interest in, but hopefully you're going to get at least one good idea. So here's an example of a widow age 75. She's healthy and she has an IRA worth $6 million today. Her life expectancy is 17 years, and that's why you see year 17. So what happens with this? Well, if you do nothing and you just leave the IRA and it grows at, I can't remember what percentage this was used at year 17, you'd have a remaining IRA of $7.5 million. She's over 70 and a half, so she has to do that. RMD is the required minimum distribution that starts at age 70 and a half, where the government forces you to take money out of an IRA or a 401k, either one. If that money was invested in a side fund, you'd end up with another $4.1 million. And if you had that $11 million, roughly $6.5 million would end up going to the government. This is assuming that this person is above the threshold that they owe estate taxes, okay? So the 40% is going to the government, and the loved ones end up getting 5.23%. Number two is use life insurance to offset that potential tax. So here we've got a remaining IRA of $6.5 million because we're purchasing $6.4 million of life insurance for $194,000 a year. At the end of the day, then the loved ones will end up with $8.849 million, and the government will get $4.1 million. So we've reduced it somewhat. A lot of people that I work with say, well, I'm not worried about that because I'm going to give it to charity. Okay, and if you give it to charity, obviously as a gift, it avoids estate tax, it avoids income tax if there's a gain in property or something that you may be giving, or in this case in an IRA, again, if we're pulling it out or our children are pulling it out, they have to pay ordinary income tax. So in this one, we purchased $6 million worth of death benefit to go to the loved ones. We're going to provide the charity with $7.23 million, and the government gets nothing. So we've totally eliminated the estate taxes and shifted all that money over to either charity or family. And then the final one is, how can you maximize IRA distributions for the benefit of the kids? So if that's where you're really wanting to emphasize where this money's going to go, we purchase an almost $9 million death benefit policy. We use the RMD side fund to fund that. There's a remaining IRA of $2.9 million. Well, that ends up at the death providing through the life insurance to the family $8.9 million. We give $2.9 million to the charity. That takes care of the entire IRA. So we don't owe the government anything, and we've done a total legacy of $11,800,000. So it all depends on what, everybody's different. And it all depends on what you want to do and what you're trying to accomplish, but really just want you to be aware that there are ways, as opposed to just sitting with the IRA and then saying at death, okay, I want this to go to this charity or wherever, we can shelter the growth of it and distribute it in other forms that may be better for what you're trying to accomplish. All right, next slide. So here's another one. I like to throw these things in every once in a while. This one I like. Dear IRS, I am writing to you to cancel my subscription. Please remove my name from your mailing list. I don't know about you, but I sure would love to do that. Okay, next slide. All right, here's one. Now we're going to get into some that are a little more complicated, but I'm going to try and boil it down to give you just the nuts and bolts of how it works. But this is, a lot of people aren't aware of this. Can you really transfer up to $1.2 million per year from your company to your family bank and deduct it? And the answer is yes. And if you look at the next slide, this is done through what's called a captive insurance company. A captive insurance company is set up as a private C company. It's a property and casualty insurance company owned by either the business owner or owners. If we get into some real estate planning techniques, a trust can own the captive. It doesn't have to be the owners of the holding company or the main company. And what this does is, under Section 831B of the Internal Revenue Code, says that a company can pre-fund up to $1.2 million per year against future claims and deduct it. Well, what are you trying to do? The main aspect here is to diversify risk and be able to take advantage of certain risks that you normally wouldn't do, either because it's just too expensive to insure it, or the likelihood of something happening is so small that you just don't insure it. Somebody that is an accountant comes into your company, does a feasibility study, and determines what type of risks you have: cyber risk, kidnap risk, lots of things you don't even think about, that they can monetize how much of a premium you can put on that. And so it's not inexpensive to set up. Typically is about $75,000 to set it up the first year, and then ongoing maybe $50,000 a year. You want a company that's making money year after year, because you want to be able to fund this. But the advantage of this is that you are basically, or your family bank is what I call it, is making all the underwriting profits that previously the insurance company was making. You're going to have some insurance, regular insurance that's going to be inside that company, but because of the fact that you're your own company, you can also go into the reinsurance market, which allows you to purchase insurance at a much less expensive rate. So you're reducing costs, you're capturing that underwriting profit. Typically, you're expected that in 80% probably of what you put in will not be paid out in claims, maybe 20%. So money to fund the captive, fully tax deductible to the company, and in the C Corp, if the investments in the C Corp are taxed and you pay tax on it just the way you would any C Corp, but when anything is distributed to the owners, it's taxed at long-term capital gain rate. So you're able to take the tax deduction on the front end, and when it's pulled out, you can pull it out at a lower rate than ordinary income tax. And so it's a great vehicle for wealth accumulation and asset protection. Next slide. So just some planning opportunities. The fact that you've got insurance reserves can be used for potentially purchasing a building, you know, whatever you might want. Life insurance is often used in it because of the fact that the cash in the life insurance is tax deferred. Not only do you get the tax deduction going in, you're buying the life insurance with tax deductible dollars. You're not paying any tax on the insurance as the cash grows. Very specialized insurance products for this that when you put $1 in, you basically have $1 of cash. It's not the typical kind of life insurance we think of. Can be used to fund deferred compensation for owners, part of a buy-sell, or to finance purchases. So there's a number of reasons why you can do this, even in addition to estate planning purposes. Okay, next. And this is real basically how it works. So top left, you have your company. Company is going to prepay premiums to the captive insurance companies, and they're deductible at the corporate income tax rate. Any losses that occur are going to be reimbursed to the company. The captive insurance company then will have underwriting profits, and those profits can stay in the captive insurance company, or they can be distributed. And if they're distributed at dividends, they're going to be distributed back to the owners of the captive insurance company at capital gains rate. And so real simply, that's kind of the structure of how a captive insurance company works. More detailed than I'm showing, but that's the gist of it. Okay, next slide. Here, if you look at what a captive can do, and this is kind of using it from an estate tax point of view. On the left, you're seeing a company making money, $1.2 million a year in profit. They may be making more than that, but we're taking $1.2 million of that. If they don't have the captive, the net after-tax cash flow is going to be maybe $700,000. You're going to earn interest or whatever on that, and you can kind of go down to the point where your total net after-tax cash flow is about $9.8 million. If you did the captive, your net after-tax cash flow in that first year is $1,068,000. And part of that is the expenses involved with setting up the captive, because you notice the second year that it's more than that. You go down, you total, you basically end up with $5 million more at the end of 10 years just from the cash flow. And since that, in this case, was done with the owners being a trust, so it was outside the estate, we ended up after estate taxes, having $14.8 million in the captive versus $4.9 million if the person did not do the captive, or almost a $10 million difference, and that's in 10 years. So it can be significant if, again, if it fits. And like any financial tool, it has to fit. And it will in some cases and it won't in others. Okay, next one. So this is what I call, would you rather pay the life insurance premium or just the interest? So sometimes in estate planning, you have a situation where an individual needs life insurance. It could be because there's no liquidity. They are worth a lot, but it's all tied up in the business. They're putting it back in the business. I have situations where somebody says, well, I'm earning 15 to 20% in my business. Why should I take that out and earn 5% in a life insurance policy? Or you have a situation where you have a large amount of premium that has to be paid. You don't want to pay gift tax on it. You may have already used up your lifetime exemptions, and it's more than your annual exclusions can be. So how can we create a way to fund the life insurance that's needed but not have to pay gift tax? So if you go to the next slide, and this one is, I don't know if you can make that any bigger, but I'll go through very briefly how this works. We go to any one of a number of large banks, all the ones you'd know, Wells Fargo, Bank of America, any of them are familiar with this. We borrow a large amount of money, basically as much premium as we can pay, and keep it considered to be life insurance. In this case, there was a need for $16 million was what they determined the need was. We take a loan from the bank for that. We use LIBOR plus a spread. The spread is, depending on how much you're borrowing, usually about 1.3 to 1.6%. So right now, this is a pretty recent one. The rate was 2.55%, so awful cheap money. The net outlay, you have to pay the interest on those premiums that are being borrowed. So that is going to be your cost for the life insurance, not the amount of money that the premium is. And if you took the same policy as a vanilla policy, the premium on this would be about $110,000 per year for life, to just kind of give you some idea of if you were just going out and said, I need $16 million, what's it going to cost to keep this thing going to age 100? One of the reasons that we're also putting in a large amount of money in the beginning is we want to have a very high cash value. And the reason for that is that the bank is always going to be 100% collateralized. But they will take 95% of whatever the cash surrender value is in the policy. So in the very early years, you're going to have to post collateral. You don't have to move money anywhere. You're just going to be responsible. If you decided to get out of this contract in the first 6 years, you would actually owe some money back because you wouldn't have enough to pay off the note. Typically, the collateral only goes about 5 years. The $16 million of death benefit is net after paying off the loan. So as you're looking at this, our loan basically caps out at $5.117 million. So the death benefit that's actually paid out is $21 million, $5 million going to the bank to pay off the loan, and $16 million going to the trust or wherever the need was for. We get down to year 17, and at that point, we've got enough cash in the policy that we're able to repay the note and have enough cash to keep this policy going forever without any more premiums. And if you go to the next slide, you can see we're now going down. Life expectancy on this person is the 33rd year. Got a ton of cash building up in this thing, and it will go forever without paying anymore. If you go to the next slide, here's an alternative. Let's say you start this out and you think you're going to need all that $16 million, and you get down to a point where either because your estate has shrunk, your assets have shrunk, or hopefully maybe because you've done some really good estate planning, you don't need that $16 million anymore. One of the things you can do is switch once that note is paid off, and we'll reduce the death benefit as you look over to the right from 16 million down to 5.2, and we're going to take out as much cash as we can out of the policy in distributions for, typically we do it for 20 years. In this case, $364,000 is coming out. Now, that's coming out income tax free, because you can take money out of an insurance policy with no income tax up to basis, which was that $5.117 million. And then after that, you can use loans to take the money out so that, again, you still don't have to pay taxes. So if you go to the next slide, you can see that this is going out roughly 20 years. Your net outlay on the interest was $1.8 million, and you pulled out of here over $7 million income tax free. And depending on what happens with tax rates, I think most of us anticipate that they're probably going to go up. This could be a great alternative to diversify your portfolio, to manage your taxes so that if you're pulling out monies from an IRA or anything else that's taxable, you may want to, for living expenses, pull out some money that is not taxable. And it's totally flexible. This is just an example. You don't have to start then. You don't have to take that much out. You do whatever you want. But this is just an example. Okay, go to the next slide if you would. And real quickly, if you have an irrevocable life insurance trust, does it smell bad? Okay, next slide. And what I mean by that is you did it, and now you have things in that irrevocable trust that you wish you didn't do. Stu's views: I need to go back in time to change my family trust plan. And the advisor says, I told you not to give $5 million to a teenager. Well, maybe it's not too late. If you go to the next slide, there's a process that's called decanting, and it's not just for wine. If you go to the next slide, in different states, and it varies by state to state, they will allow you within certain guidelines to change the trust or create what's called a pour-over trust that has the ability to amend some of the things that you put in your irrevocable trust. So if you have one that you think you can't possibly change, it's locked in, you can't ever do anything, not necessarily the case. Maybe, but again, it's state to state as to where the trust is sightest as to whether you can. So just be aware that it doesn't mean that that can't be changed. If there's a reason that has come up that you might want to do that, there's a possibility that you can. Okay, I think that's it.
Okay.
Thank you so much, Roger. We do have a couple of questions, and one I would like to address. We had several questions about the presentation being available. Yes, you will receive a copy of this presentation within the next 24 to 48 hours. That will be sent to your email, as well as it will be posted on our website in a few days. So you can access that information there as well. And the question, let's see, we have a first question is from Matthew, and he asked, where should I start if I have not done very much planning at this point?
Okay. And that would not be unlike many people. I think the beginning part, I would say, is to get core documents done, because I think that's the most important thing, that you make sure if something unexpected happens, you've got everything in place that somebody can take care of whatever decisions need to be made. So that's number one where I'd start. The next place that I'd start after that would be to go to an advisor, and it may be a CPA, it may be a tax attorney, could be a financial planner, insurance professional, to really kind of take a look at your whole picture. First of all, what are all your assets? How are they structured currently? Who owns them? What, and get into a discussion. I think this is where people like myself probably are a little better than a lot of times the CPAs or the tax attorneys. They're kind of transaction oriented. You go in, you say, I want this, and they say, good, I'll do it. Here's how much it's going to cost. I try and get into a lot more depth on the family, the business, what concerns you, what are you trying to achieve, because that plays a huge part into designing a proper plan. But that would be where I'd start.
Okay. Thank you. And we also have a question from Catherine. She says, I have advisors that I currently work with. If I want to work with you, would you be willing to do so?
Sure. And I personally believe that the team approach is the best approach possible. Because although I know a little bit about tax law and a little bit about this, and the tax attorney may know a little bit about insurance, everybody's specialized in what they do, and I think you'll always get a better result if you have a team working together, not just having a team, but they've got to talk to each other, and that is the best way to do it. So anybody that somebody works with, that's great. I'll work with any of them. If they don't have somebody.
Yeah, and keep in mind too that Roger's information is going to be made available at the end of this presentation. So if anybody would like to reach out to Roger, feel free to do so. Sorry to interrupt.
I'm sure there may be some questions that come up that you had as related to some of these things that we went through, and be happy to go through with in more detail, or as it relates to your specific situation.
And Roger, I have one final question, and I'm not sure if you want to answer this one or not, but I'll ask it anyway. Will you share how much you will charge to work with someone, or at least give a ballpark?
Sure. Actually, I make my earnings off of commissions. Occasionally, I'll charge a fee if there's a situation where there just is not any opportunity for products, but that will be known up front. I don't come at the end and say that. So I don't charge anything to go in. And in fact, one of my partners is a JD CPA, no longer practices, so he's not in conflict with any of your potential advisors, but a great individual to review trusts, buy-sell agreements, etc. No charge for that. We feel like if we can come in and help you organize your thoughts, what you've done so far, most of the time we can come up with some strategies that will help take care of the expenses that we cover. So we don't charge a fee, and we're independent, so we sell through any insurance company, any product. You're the client. We're trying to do what's best for you.
Great. Thank you so much, Roger. And Kevin, I will turn it back over to you at this point.
Okay. if you could, just go ahead and advance the slide, Robin.
See if I can get to it. There we go.
And so, first of all, this webinar was hosted by Chief Executive Boards today, and I want to invite you to visit our website for any additional insights and some upcoming events, such as the webcast that you see listed on this slide here. So our next one will be June 22nd on cybersecurity for small and mid-sized businesses. And then we'll host another one again on July the 20th, really about how do you remove the drama out of a business. And so those are really good webcasts that we'll have coming up over the summer, and want to invite you to join us for those. And you can find the registration for those on our website as well. So here is a slide with the contact details for either myself or for Roger. If you would like to contact either one of us, if you have any questions, then we want to invite you to feel free to do that. I'd like to thank our presenter today, Roger Brooks. Roger, you've done a delightful job in spite of our technical difficulties. I apologize for that, but we are dealing with technology, and those things happen.
Well, and I'd like to thank everybody on the call for taking time out of their busy day to listen. So thank you.
All right. And so we hope that you've found the presentation to be helpful. And we want to invite you to contact either Roger or myself if you have any questions. And please join us for future webinars. We look forward to speaking with you regarding future engagements, and want to wish all of you a great week ahead. And so thank you and farewell. And this concludes our webinar.
Thank you.
Thanks, Roger. Thanks, Robin.